Thank you very much, Michael, and good morning, everybody. Lloyd, as a warm-up act, I think you're a little bit too good. It's like Leo Sayer following the Beatles. This is a little bit intimidating. But I'm afraid you're going to have to discard everything Lloyd said, because no vision, no business plan, no financials. We definitely wouldn't have backed you back there. Shows what I know about investing. But anyway, raising capital, having a successful business is all about timing, and unfortunately there's never really been a tougher time to raise money than the current climate. Suggestions that there's more capital on the sidelines than ever before is somewhat meaningless unless that capital is being put to work. For all the talk about the government-backed Project Merlin scheme, the Business Growth Fund initiative, we're not seeing a wave of investment in entrepreneurial initiatives. The Business Growth Fund has, in my mind, and its somewhat flawed wisdom, decided to only focus on businesses generating more than £10 million in revenue, and I think they've missed a significant opportunity to tackle earlier stage businesses that often have far more prospects for growth than many of those businesses in excess of 10 million. What we have been touted as a very investment-friendly policy, the EIS scheme, hasn't actually translated in a flood of angel investors continuing to invest more than they had prior to these EIS changes. And it's no surprise that the government is reviewing their EIS policy, and I suspect over the coming months we're going to see further changes in that scheme. So for businesses looking for capital in the current environment, it's absolutely critical to have your ducks in a row to ensure you've got the best chance of raising capital. And as an entrepreneur, I've gone through the fundraising experience 4 times over the last 15 years. I'm probably pretty much a novice amongst many of you seasoned entrepreneurs here. However, having changed hats, I now run a fund that targets investment in growth technology and internet businesses, and we back businesses that generate less than 10 million in revenue. So I guess not having the growth fund is more opportunity for us. Raising funds is also as challenging as raising capital as an entrepreneur, as a startup. In 2006, the average VC private equity fund took 9 months to raise a fund. Today, it's taking more than 26 months to raise the same amount of money. So venture capital funds, private equity funds are finding funds hard to come by, and as a result, they're taking that little bit longer and holding on to the purse strings that little bit tighter than they have before. Now, on the flip side of that, you have some funds that are under huge pressure to invest because they've been holding on to their capital once they've nursed their portfolio post-2007, 2008, and they're under pressure to invest. However, I would say, in my time, there's not as much dumb money as there was a few years ago. In bull markets, great, good, mediocre businesses often receive funding, and in many cases, really bad businesses receive an inordinate amount of funding. However, in the market that we find ourselves in now, only really the most outstanding businesses are finding it easy to raise capital, leaving many businesses at the inflection point of growth wondering what might have been. And as a result, it's absolutely imperative that companies recognize and embrace some golden rules if they decide they want to raise venture capital. Now, I'm sure everybody here has watched Dragon's Den, and I know Julie is an online judge, and I think it's great TV, but for many of the young entrepreneurs out there, it's not actually what happens when it comes to raising money. You walk into a room and 15 minutes later you get a hug and a pat on the back and say, well done, or you're kicked out the room. It's a little bit different, and so I think it's fantastic for many kind of young aspiring entrepreneurs out there, but the true story is a little bit different to that. This year our funds received over 300 proposals for funding. Many miss the mark as they simply don't kind of hit our criteria. They're either too early stage, they're in the wrong sector, it's the wrong geography. Those are the easy ones to kind of pass by. But about 50% make it through the first filter. And we only have £50 million in our fund. We've invested already 30. We've got a 20 million to invest in Fund 1. And we've already been requested for £1.7 billion worth of funding. So the majority of our of the opportunities come through the door, we're going to say no to. Now, much of the advice I'm about to impart might seem incredibly obvious and straightforward, but it's fair to say that over 90% of the companies that come through the door do not kind of follow I'm calling it 10 golden rules, but I think I've written a few more than 10, so we'll see how many I get through before I run out of time. I think kind of one of the first things you must recognize as an entrepreneur and as a founder of a business is you need to, if you want to bring venture capital, you need to know what that entails. For many people who have friends and family investors, who have angel investors, there comes a very different dynamic when you bring venture capital in. And I think you need to understand what that means. I'm not going to talk about it today. I could spend another 20 minutes talking about it, but it's certainly something that you need to recognize going in. Definitely the shift changes somewhat. And despite, from our perspective as a fund, despite making it very clear what we focus on, it couldn't be clearer on our website, the type of businesses that we target. It's extraordinary the amount of people that write to us, call us and say, can we have a meeting? This is what I'm doing. And I said, have you seen the website? He said, actually, no. I recently got a adult call center in Slovakia wanting £5 million. I said, actually, that's not really our focus. And he said, well, can you recommend me to somebody who would? And I said, look, unfortunately not. But if anyone knows here, let me know. But I think, a lot of people are coming in cold. And I think if you take the time to look at the company, look at the fund, look at the portfolio, and if you can see some similarities, whether it's in industry, in the type of dynamics that they've got, that goes a long way to getting that first meeting. Don't overload the potential investor with paperwork. I received a proposal a couple of months ago, quite an interesting business at first look. We decided to take the meeting, and prior to the meeting, I then received 3 emails with 15 attachments. And it was absolutely extraordinary. As an investor, if I can't work out what the business does in an executive summary, then we're not going to invest. I'm sure smarter people might be able to kind of work through it, but if we can't articulate what that business does, then it really does scare us off. And that business might have been a fantastic business, but we were totally overwhelmed with paperwork, and in the end, we didn't pursue it. I think, recognizing that every single financial model, every single business plan in year 3 and 4 has a hockey stick projection. They're all the same. You see the line, then it goes like that. So investors pretty much ignore that. The amount of times I said, but in year 3 is when we really make the money. I think it's all about really articulating what your vision's about. Having credible financials is critical, but more critical is understanding and articulating how you're going to achieve them. Now, investors are backing the entrepreneur as much as the idea. And, if you have business partners, the chemistry absolutely has to be right. That goes without saying that first meeting with a potential investor is all about chemistry, and it's all about how you portray yourself. You can have the best idea in the world, but I guarantee you that if you can't sell it, you're very unlikely to get investment. Try and raise money from a position of strength. I recognize that funding is a real distraction, but it always takes longer than you think, and your leverage is compromised the longer it takes. We recently looked at a very interesting technology payment company which has some good traction. The problem was that the company had left it too late. The founder had left it too late. His cash flow was running out. And, these things don't happen overnight. They take a few weeks. If you have a meeting, it probably takes another week to follow up. The entrepreneur sadly became increasingly desperate, was running out of cash, started to become quite irrational in his behavior, calling up, why aren't you investing, which, it sounds rather odd, but it happens. And it was just, the guy had sunk all his money into it. It was an interesting idea, but simply how he was portraying himself to investors left him, a fair bit to be desired. And I suspect that business is not going to get funded. Prepare yourself for significant distraction. If you're the guy out there holding the meetings, then you need somebody, if possible, back in the office doing the work. It is a time-consuming, somewhat exhausting process. It can be demoralizing at times, it can be tiring, but you will take your eye off the ball. And as a result, it's absolutely critical that you have someone keeping their eye on the business. Don't put your eggs in one basket. As an investor, I will always say, you should go with us. We understand what entrepreneurs are all about. A lot of other venture capital firms don't really get it. But if I'm sitting in your shoes, irrespective of the chemistry and the dynamics you have with one particular investor, you need to have backup opportunities out there. Again, using an example of a very interesting e-tailer that we spent 2 or 3 months with recently, really getting them to understand, what they wanted, how much money did they want to raise. By the time they'd addressed their financials, they'd really committed to funding and said, right, we want the money now, and we need it now, and, when are you guys going to invest? We said, well, actually, we're probably not going to invest. Doesn't quite fit our profile, which we had told them, but they convinced themselves that we were the guys to take their money, and as a result, they hadn't spoken to anyone in the 3 months prior to that. So certainly left the CEO and founder there in a hole, and again, put him under real time pressure from a cash flow point of view. Don't tout yourself too widely around. I think the London venture community is a small community, and people talk, investors talk amongst each other, irrespective of the fact that you might not have touted yourself too widely. If people get the sense that this is an opportunity that others have seen and others have seen for quite some time, it becomes quite a serious negative. People start to question, why haven't they done it? If they've seen it, why haven't they looked at it a little bit more closely? So do not allow those that advise you, and some people will engage formal advisors, be very clear and understand who they are talking to, and do not allow them to tout it too widely around.